What happens when the world's largest manager of money begins to subtly change its course? Recently, there has been significant discussion and analysis around the investment strategies of BlackRock, a firm responsible for stewarding trillions of dollars for institutions and individuals worldwide. Some observers have pointed to strategic shifts in how the firm is allocating capital, particularly concerning its exposure to the United States market. This has sparked widespread curiosity and even some unconfirmed rumors of monumental capital movements. This video aims to unpack that discussion from a neutral, educational standpoint. We will explore the context behind these observations, examine the fundamental factors that influence such decisions, and discuss the range of possible implications, all without hype, speculation, or directives. This is a complex story about risk, geography, and the constant recalibration of global finance. Chapter 1. Market background and historical context. To understand the present, we must look at the past. BlackRock's role in the global financial system is that of a fiduciary, a steward of capital. It manages assets for a vast array of clients, including pension funds seeking stable returns for retirees, sovereign wealth funds planning for a nation's future, and individuals saving through long-term plans. This responsibility means its primary objectives are managing risk and seeking returns within the constraints set by its clients and the market environment. The firm's growth to managing over $10 trillion in assets is a story of modern finance, reflecting the rise of index funds, sophisticated risk analytics through tools like its Aladdin platform, and the increasing consolidation of asset management. Historically, the United States market has been a cornerstone of global investment portfolios. For decades, it has been perceived as a deep, liquid, and innovative market, home to many of the world's leading companies and backed by the world's primary reserve currency. This created a historical tendency for significant global capital to flow towards U.S. assets. However, history also shows that capital flows are not permanent. They shift in response to changing dynamics like interest rate differentials between countries, relative economic growth rates, geopolitical stability, and long-term fiscal outlooks. The post-World War II era saw the dollar's ascendancy, the 1980s saw Japanese investment surge into the U.S., and the early 2000s saw the rise of sovereign wealth funds. Each period involved major institutions reassessing where in the world the best balance of risk and return could be found. Therefore, analyzing any single firm's strategic adjustments requires viewing it within this long history of global capital in motion. Chapter 2. Current observations and market developments. Moving from historical context to recent developments, financial analysts and news outlets have reported on observable changes in BlackRock's public positioning and investment products. It is crucial to frame this informationally. These are observed developments, not predictions of future events. Reports have included analysis of the firm's investment commentary, which has increasingly emphasized themes like global diversification and the identification of investment opportunities in markets outside the United States. For instance, some of their published market outlooks have discussed potential in sectors and regions undergoing specific transformations, such as infrastructure development in certain emerging markets or technological adoption in Asia. Furthermore, there has been a noticeable expansion of investment products like exchange-traded funds, ETFs, that focus on non-U.S. markets, giving their clients more tools to allocate capital internationally. Concurrently, there is an ongoing, separate discussion in financial media about the United States macroeconomic environment. Key points in this discussion include the size of the national debt, the trajectory of government spending, and the policies of the Federal Reserve regarding interest rates. These factors are publicly available data points that all investors, large and small, consider. It is within this environment of public data and analysis that the rumors of extremely large-scale capital reallocation have emerged. It is vital to distinguish between verified, strategic communications from a firm and broader market speculation. The former involves official filings, shareholder letters, and product launches. The latter often involves unverified commentary on social media or in less formal financial outlets. The specific figure of $2 trillion being moved is not something found in official BlackRock reports. It is a speculative concept that has circulated within certain discussions about global capital flows. Therefore, the current situation is a blend of verifiable strategic trends from a major asset manager and much less verifiable rumors about the specific magnitude of capital movement. Near Chapter 3, Key Drivers and Fundamental Factors. Why might a firm like BlackRock, or any large institutional investor, consider adjusting their geographic allocation of capital? The reasoning is typically based on a multivariable analysis of fundamental factors. Analysts observe that decisions are rarely about one single issue, but a mosaic of interconnected considerations. One primary factor is the search for relative value and growth. Some investors look at valuation metrics in U.S. markets, such as price-to-earnings ratios, and compare them to similar metrics in other developed or emerging markets. Under certain conditions, some analysts believe other regions may offer more attractive valuations for future earnings growth. A second major factor is risk management concerning macroeconomic stability. Key elements here include fiscal policy, monetary policy, and currency strength. A nation's debt level and its growth rate are metrics that economists monitor. High debt, relative to the size of the economy, can lead to several possible outcomes that investors analyze. These potential outcomes include the possibility of higher future taxes, which could impact corporate profits, or the potential for rising long-term interest rates if the government's borrowing needs crowd out other borrowers. Higher interest rates can affect the present value of future earnings for companies and influence the attractiveness of bonds. A third factor is geopolitical and regulatory landscape. Some investors assess the stability of the regulatory environment and the direction of trade policies. Changes in these areas can alter the risk profile of investing in a particular country. Finally, there is the factor of innovation and market depth. While the U.S. has been a leader, other regions are developing deep capital markets and leading in certain sectors, like renewable technology or digital payment systems. For a global asset manager, its duty involves scanning the entire world for opportunities that match its clients' risk and return objectives. A shift in emphasis could reflect a model that suggests the probability of achieving those objectives might be changing in different parts of the world. It is a continuous process of analysis, not a one-time reaction. Chapter 4, Comparisons and Potential Scenarios. To better understand the range of possibilities, it can be helpful to consider different scenarios and comparisons. It is important to state clearly that these are hypothetical illustrations of how markets function, not forecasts. One possible scenario, often discussed by economists, is a gradual and managed rebalancing. In this scenario, large institutions might slowly increase their allocations to international markets over a period of years, seeking diversification. This could be a response to a belief that other economies are entering a phase of stronger relative growth. The effect on the U.S. could be moderate, potentially leading to a slightly stronger U.S. dollar in the short term as assets are sold, but also possibly leading to higher long-term interest rates if demand for U.S. debt moderates. Another scenario involves a more pronounced shift driven by a decisive change in global macroeconomic conditions. For example, if major economies were to diverge significantly in their inflation control or fiscal management, it could prompt a faster reallocation of capital. The implications here are more uncertain and could involve greater currency volatility and shifts in capital availability for different sectors. A third scenario is that the observed trends are minor and temporary. U.S. markets have shown resilience for decades, and their depth and liquidity often attract capital during global periods of uncertainty. It is possible that after a period of reassessment, the relative attractiveness of U.S. innovation and corporate governance again draws capital back. Historical comparisons might be made to the late 1980s, when Japanese investment in U.S. assets was very high, or to the period after the 2008 financial crisis, when U.S. markets recovered strongly. Each period was unique, but they all show that capital flows are cyclical and dependent on a constantly changing set of variables. The outcome of the current environment is uncertain and will depend on a multitude of future developments in policy, economics, and global events. Chapter 5, Risks, Volatility, and the Imperative of Personal Research. This leads directly to a mandatory discussion of risks and volatility. Any discussion of large-scale capital movements must be accompanied by a clear acknowledgement of uncertainty and potential downsides. There are risks in every investment decision, including the decision to change a geographic allocation. For markets, a rapid reallocation of capital can be a source of significant volatility. Asset prices are based on supply and demand. Large changes in demand can lead to price swings. Furthermore, moving capital into new regions introduces new types of risks, including political risk, currency exchange rate risk, and different regulatory or legal risks. The rumors themselves, even if unconfirmed, can create market narratives that influence short-term trader behavior, adding another layer of volatility. It is also critical to understand the risk of misinterpretation. Observing a firm's strategic shift is not the same as receiving a signal to act. Individual investors have different goals, time horizons, and risk tolerances than a multi-trillion-dollar institution managing pension funds. What might be a prudent risk management step for a giant fiduciary could be entirely unsuitable for an individual's retirement plan. This is why the core message of this educational content is to empower you with information while stressing the necessity of independent research. You are encouraged to consult a variety of reputable sources, including official economic data, filings from investment firms, and analysis from multiple licensed financial advisors. A licensed professional can help you understand how global trends might interact with your personal financial situation. Relying on a single source of information, especially one involving speculative rumors, is inherently risky. The financial landscape is complex and outcomes are uncertain. Making informed decisions requires a disciplined, personal, and well-researched approach that ignores hype and focuses on fundamentals and long-term planning. Conclusion and neutral summary. In summary, the discussion around BlackRock and global capital allocation is a potent case study in how macroeconomic factors, risk management, and market speculation intersect. We have observed a verifiable trend of the world's largest asset manager placing a public emphasis on global diversification and opportunities outside the United States. This occurs against a backdrop of widely analyzed macroeconomic conditions in the U.S., including public debt levels and interest rate policy. Separately, there are unverified rumors of specific colossal capital movements, which should be treated with caution and a demand for verified evidence. The key takeaway is educational. Large investment firms constantly adjust their strategies in response to a changing world. These adjustments are driven by multivariable models aimed at fulfilling fiduciary duties. For the individual observer, this story highlights the importance of understanding fundamental drivers like fiscal policy, interest rates, and relative valuations. It is a reminder that global finance is a dynamic system, and no single market holds a permanent monopoly on opportunity or risk. Disclaimer: this video is for educational and informational purposes only. It is not personalized financial advice in any form. The content presented represents an analysis based on publicly available information and should not be construed as a recommendation to buy, sell, or hold any security or investment, or to make any financial decisions. All investment involves risk, including the permanent loss of principal. Past performance is no guarantee of future results. Your financial situation is unique, and you should consult with a licensed, qualified financial advisor or conduct your own thorough research before making any investment decisions. The creator of this video is not a licensed financial advisor and does not endorse any specific investment strategy. The views expressed are analytical and neutral, based on the information available at the time of recording, which is subject to change.